And live now for remarks from Congressional Budget Office Director Keith Hall. He'll be speaking with reporters today about the CBO's budget and economic outlook for 2019 through 2029. Live coverage here on C-SPAN.
I have control here. Okay. Good morning. I'm Keith Hall, the Director of the Congressional Budget Office. Thank you for joining me today to talk about CBO's most recent analysis of the outlook for the budget and the economy, which we released just this morning. I'd like to draw your attention to important information in that report about the amount of debt that the federal government will incur if we continue on the current budgetary path. I'm going to focus on 4 questions in my remarks. How large does CBO project that debt will become? Why is debt projected to become so large? What would happen if the economy grew more quickly? And what are the consequences of high and rising debt? The first question, what does CBO project? Federal debt is already large, and budget deficits over the next decade and beyond are projected to keep pushing it up in relation to the size of the economy. Eventually, debt as a share of economic output would reach its highest level in our nation's history. Let me highlight a few key numbers. At the end of 2018, the amount of debt held by the public was equal to 78% of gross domestic product. In CBO's projections, debt equals 93% of GDP by 2029 and about 150% of GDP by 2049. Even at its highest point ever, even after World War II, debt was far less than that at 106% of GDP. Second, why does debt become so large in CBO's projections? You can see that answer in the summary of the report, which we provided to you as a handout. This year, we've summarized our findings in a new way. We've used some charts in the report to illustrate some key messages. If you look at the charts, the figure on the bottom of the first page indicates why debt grows so much. I'll see if I can do the screen here as well. This figure clearly shows federal spending and revenues both grow over the next 10 years, yet the gap between them persists over that time. On the spending side, growth is driven by benefits for older people and by interest costs. Outlays for Social Security and Medicare increase significantly in CBO's baseline projections. As members of the baby boom generation age, the number of people at least 65 years old who are the main beneficiaries of that spending is expected to grow by about 1/3, and their health care costs will continue to rise. Interest costs are also projected to rise primarily because of increases in federal borrowing and higher interest rates. As for revenues, they too are projected to increase through 2029, partly because of the scheduled expiration of some tax cuts at the end of 2025. However, that growth in revenues is not enough to keep deficits from being significantly larger than they have been over the past 50 years. In CBO's projections, the average deficit over the next 10 years equals 4.4% of GDP, as shown by the picture on the front of your handout. Now I can switch to another picture here. This is one of our more sobering pictures. That average deficit is not only large, but also unusual for times of low unemployment, in contrast to times of high unemployment, where the government sometimes implements policies aiming to stabilize the economy, causing deficits to be larger. Third, what would happen if the economy grew more quickly? If GDP grew more quickly than it does in CBO's projections, revenues would increase more than spending would, and deficits would be smaller than projected. If economic growth was fast enough, deficits would actually shrink, and debt would stabilize or even fall as a percentage of GDP rather than continuing to grow. But such an outcome is unlikely. In 2018, the real growth rate of the economy, that is growth with the effects of inflation removed, was 3.1%, the highest rate since 2005. Nevertheless, the deficit equaled 3.8% of GDP, and debt increased as a percentage of GDP. Furthermore, this year, the boost that recent tax legislation gave to business investment wanes in CBO's projections. Also, federal purchases dropped sharply under current law, starting in the fourth quarter of the year. As a result, economic growth is projected to grow slow in 2019. Over the longer term, output growth is projected to be lower than its long-term historical average because the working-age population is expected to grow more slowly than it did in the past. Real GDP grows by an average of 1.8% per year in CBO's 10-year budget projections. In short, the economy isn't likely to grow quickly enough to shrink the budget deficit. We have posted an interactive workbook on our website that lets you specify different economic scenarios and see the results. For example, if productivity growth turned out to be 0.5 percentage point higher in every year than CBO projects, real GDP would grow by 2.4% per year over the coming decade instead of by 1.8%. Deficits would still average 3.7% of GDP instead of 4.4%. And debt would stabilize at roughly 80% of GDP by 2029. Such economic growth is possible, but is not likely under current law. CBO aims for its projections to be in the middle of potential outcomes. So there's about the same chance that productivity growth would turn out to be 0.5 percentage point lower than CBO projects. If that happened, real GDP growth would average 1.1% over the decade. Average deficits would be 5.2% of GDP, and debt would swell even more than it does in CBO's projections. Fourth, what are the consequences of high and rising debt? First, as interest rates continue to rise towards levels more typical than today's, federal spending on interest payments would increase, surpassing the entire amount of defense spending by 2025 in CBO's baseline projections, for example. Second, because federal borrowing reduces national savings over time, the nation's capital stock would ultimately be smaller and productivity and total wages would be lower than would be the case if debt were smaller. Third, lawmakers would have less flexibility than otherwise to use tax and spending policies to respond to unexpected challenges. And fourth, the likelihood of a fiscal crisis in the United States would increase. In closing, I will emphasize that debt is on an unsustainable course in CBO's projections. To put it on a sustainable one, lawmakers will have to make significant changes to tax and spending policies. Making revenues larger than they would be under current law, making spending for large benefit programs smaller than would be under current law, or adopting some combination of those approaches. I'm joined at the table, or will be joined at the table, this morning by Wendy Edelberg, Associate Director for Economic Analysis, and around the room by some of the many people at CBO who worked on this report. So my colleagues and I would be pleased to answer your questions. And if you would, when you ask a question, if you could share your name and your organization, that would be great. Thank you. Welcome.
Paul Krozak, CQ roll call. So in this visual summary that you've handed out, so in the past the rule of thumb was sort of spending was about 20% of GDP and revenues were about 18% of GDP. And it shifted, and as you point out here, between 1969 and 2018, average revenues 17%, outlays 20%, which is what it was before. So the average revenue figure has gone down a little bit.
Right.
Why is that, and what are the implications of that?
Well, it's below its 50-year average revenues are because of the Tax Act. That really did lower revenues. But you'll see that it's not that long. It's within the 10-year window before the revenues grow enough, particularly if the individual income tax rate decline is reversed, then that will go up and be above the 50-year average. I think 50-year average is about 17.4%. We think it's going to get up to over 18% by the end of the decade.
And so to follow up, so revenues get back up to around 18% by the end of the decade, but spending gets up to 23% above the long-time average of 20%.
That's right. That's right. They both will increase, but spending increases just outstrips the revenue increases.
And is that primarily because of the mandatory spending programs, which are growing faster than economic growth?
That's right. It's primarily mandatory spending, and what's behind that is an aging population and growing healthcare costs are just pushing that mandatory spending up fast.
And increases in net interest have a large contribution to the deficit over the 10-year projection as well.
That's right. It's one of the reasons why we make that comparison to defense spending, because it's getting to be a very large part, net interest payment alone, a very large part of the budget. And when I say it's going to be larger than defense spending, it's also going to be larger than all of non-defense discretionary spending, either one. So it's getting quite large.
If you could talk a little bit about your analysis of the cost of the shutdown to the economy. You say it's $11 billion over 2 quarters. Can you put that in perspective for us, both in the short term and the long term?
Sure. If you like, I can give a little bit of a summary of our analysis. The total discretionary funding that was impacted by the shutdown was about $329 billion on an annual basis. And of course, the government wasn't shut down for a year. It was shut down for 5 weeks. But the effect of that was to lower compensation to federal workers and to lower federal spending on goods and services by about $18 billion in that 5-week period. So for the fourth quarter of last year, that's a decline in GDP of about $3 billion. It's primarily from lower government output, but it's also the indirect effects of federal spending by federal workers. And then in Q1, we think the GDP will be down by about $8 billion. But the first quarter, that $8 billion reduction all happens in 2 weeks. I'm saying 1 week. So the other 2 weeks is part of the recovery. So overall, we see the reduction over the second quarter be, and fourth quarter and the second quarter be about $11 billion reduction in GDP. So we have lower GDP in Q4 and Q1. Where that comes from, let me summarize just a little bit. We had 12 departments and agencies affected by this shutdown. 800,000 employees were not paid over that time period out of 2.1 million employees. So that's about 40%. The 12 departments were pretty wide-ranging. Spending of goods and services, including many contractors, were affected. That was lowered. One of the things that we did not take into account, but which is in effect, is some grants and subsidies and spending and benefit programs. Those were affected, but we didn't include that in our analysis. But we do think that once the government's back in place, federal workers begin to work again. We think there'll be a fairly quick recovery from that. There is a permanent loss, however, right? You lose the government output for 5 weeks. That's never made up. So we think on net, we're still going to be about $3 billion short on GDP. But that recovery will take about 3 quarters to the end. It also doesn't take into account, which I would call the distributional effects, because the effects of the shutdown, we're giving you the national data numbers. But in fact, obviously federal workers were really impacted from delayed compensation. They're in this, a lot of them are in this region, so it's a regional effect. Private contractors are really affected. We expect the government, when the government comes back, that the government's going to spend its appropriation. They may not spend it quite the same way as they would have without the shutdown. So you can imagine, for example, some contracted services. It could be anything from custodial services to other things. They will have a permanent loss because the government's not likely to go back and pay those, although the government's likely to still spend the money. And then there are probably other effects which we don't take into account, which aren't so strong yet, but which would be very strong which would be stronger anyway if the shutdown lasted longer or if it picked back up. Those needing federal permits and certifications might become affected at some point. That will have an effect on the economy. Risk would be higher for those low probability, high cost events. One of the things that I always like to point out, Of those 2.1 million federal workers, 2/3 of those work for either the Department of Defense, the VA, or TSA. So security is a big part of that. Household business decisions made without economic data. The Commerce Department was shut down, so we didn't have economic data from the Census, the Bureau of Economic Analysis. Then we have investor confidence. You know, if this lasted long enough, we could actually see an impact on investment and hiring going forward. And then, of course, there's a last thing which is not really counted here is the federal hiring. When you do this sort of thing, you impact the morale of federal workers, and it may have some impact on the quality of federal workers going forward.
These are all things that you did not include in the analysis.
That's right. But they would be things that would make the impact bigger if this continued for longer than 5 weeks.
Do you have a sense of what that breaking point might be, or is it unknowable when, you know, if it was 6 weeks or 7 weeks, would that start to become more significant?
Yes, it's kind of unknowable because a lot of it involves people's confidence, you know, and of course, again, if we survive 5 weeks without any incidents, for example, security incidents, but you know that's the chances of that would go up if we shut down again, that sort of thing. Lack of economic data, that's near and dear to our heart. Is economic data is really important for us to understand what's going on in the economy, what's going on with the budget. So that has an impact, and people make decisions based on economic data.
Steve Cooper with Tax Notes. Does your report tell us what the impact of the 2017 tax law had on the U.S. economy for 2018? I know it does mention that it's going to wane this year, but what happened last year?
Sure. Actually, we remain very happy with our estimate of the effect of the Tax Act. We estimated that over 10 years it would be about $1.9 trillion. The implementation was about what we expected. The tax revenues came in about what we expected. The composition was about what we expected. The biggest surprise on the tax revenue side was corporate tax revenue wasn't as high as we projected. It's not clear that was any sort of impact from any different from our estimate of the Tax Act, because that was continuing a trend that had started before the Tax Act was imposed. And it's one of those things where the tax data on corporate income taxes, it just lags behind. So it's really hard to know exactly why that's come in lower than we expected. But on the whole, I think we're actually pretty happy with what our estimate was from last year.
Sure. During the run-up to the tax bill passing, we were told by the Treasury Secretary that the tax cuts would pay for themselves and they would bring all this new revenue in, and that we shouldn't worry about the deficit because the deficit would be taken care of by the economic growth. Did that pan out over 2018?
We're still happy with our estimate of the growth effects of the Tax Act. Over 10 years, we think the growth effects will be positive, but we think that means that on net, the tax bill paid for about 30% of itself rather than 100% of itself. So again, the budgetary effects of the extra growth did boost revenues, did close the deficit some, but not all of the lost deficit from the Tax Act. Yes.
Rich Miller at Bloomberg. I wonder if you could explain the movement in unemployment that you see over the next couple of years. I apologize, I haven't read the whole report.
Right.
But I mean, you have growth slowing, what seems to me marginally below trend. Yet you have the unemployment rate jumping from 3.5 to 4.4, almost 1 full percentage point, and I'm having a little trouble reconciling those two. But it may be in here, and I apologize.
Well, what we believe is going on now is that there's been a fair amount of stimulus put into the economy. And because of that stimulus, we have growth above trend. So growth is strong. It's above 1.8%, right? We expect 2.5% this quarter, 2.3% for the year. So it's above trend, but that's in large part that's stimulus growth. And although the Tax Act will probably leave our level of GDP higher, the growth effects are going to wane, and that stimulus is going to drop off. And so we think the payback for that, of course, is once you have growth above potential, you now have growth below potential for a while. Plus, of course, under current law, we have government spending being constrained by the caps. In a couple of years, the caps go back into place. So spending will go back to being constrained. Plus, under current law, the individual income tax rates that were lowered will go back up in 2025. So all those things will tend to destimulate the economy. So that's part of why we think the growth is going to drop below trend before settling back into the trend level of about 1.8%.
Sorry, I didn't make myself clear.
Okay.
I realize that it seems to go like 0.1% or 0.2% below trend, which, marginally below trend.
Right.
Yet the unemployment rate jumps up almost 1 full percentage point, which I don't know what the open floor is, but it suggests to me that it seems like a big rise in the unemployment rate for what seems to be this fairly small shortfall below potential. Sorry, it wasn't clear.
Oh, no. I went off to a standard answer without listening carefully. I'm sorry. It's kind of two things, I think. One is the stimulus goes, right, and we move the unemployment rate moves back towards its potential. But the second thing is we still have this aging population. We still expect that labor force participation is going to decline over time, and that's going to start to kick in here over time. So not only do we get back towards potential unemployment, potential level of labor force participation, but then that potential itself is declining because of the aging population. So that's why it looks like it's an extra rise over time.
I also think that the shortfall of actual GDP growth relative to potential GDP growth may be a little larger than what you have in mind. So we estimate the potential GDP will be about 2% over the next several years. So it's actually a little higher over the next few years than it is in the longer term. So the shortfall may be a little.
Jeff at the Washington Post. Can you elaborate a little bit more on the 30% pay for itself versus 100%?
Sure.
What's the 30% they're derived from?
Well, it's purely, if you look at our 10-year estimate of the effect of the Tax Act, and you look at the effect on the deficit before macroeconomic effects are included, and then you look at the ultimate with macro effects included. With macro effects included, you get an increase of the deficit of about $1.9 trillion. Without taking those into account, you get an increase in the deficit of about $2.3 trillion. So that difference there, the difference there is about 30%. Just a nice sort of back of the envelope way of sort of addressing that issue about.
So if the other number was 0, or if 10, you would get 100%, right?
That's right. That's right.
Kate Davidson from the Wall Street Journal. Could you talk a little bit about the effects of new tariff policy on the budget and the economic outlook?
Sure. Well, first of all, we had to be careful about what we assumed about tariff policy. We took the tariffs that are in place and assumed that those would continue indefinitely. So we have tariffs on about 10% of imports, and then we have the retaliation. From that, tariff revenue is up in our projection, as you might expect. But we see a drag on the economy. We think in the next couple years, the level of GDP will be about 1/10 of a percentage point lower. And we think over the whole decade, it'll be about 1/10 of a percentage point lower than it would be otherwise. But we're also assuming that the planned increase in tariffs, that 25% increase in tariffs on Chinese imports, et cetera, that doesn't happen. And if that happens, that will have additional effects. If you look in our Chapter 5, we have alternate scenarios. We have a little bit of an estimate there. What if those 25% tariffs do go into place? What would happen? And we also have what happens if the current tariffs go away, how that would happen. I don't have that number right in front of me, but that will give you some idea.
So right now, you're basically saying the drag is offsetting, more than offsetting the benefit.
That's right. That's right. And and the tariff effects are it's a little hard to forecast. But when you think about tariff effects, what tariffs are is tariffs is an increase in tax, and it's paid for by U.S. importers. And then the next thing is to figure out how U.S. importers deal with that tax, how much they're able to pass forward to U.S. producers, how much they pass forward to U.S. consumers, how much they are able to pass back to foreign producers. So it's a little bit of a tough calculation. but the effects they're like taxes. It's what they are. So it's got something like maybe a sales tax on consumers at some point once it sort of works through the economy.
So just to give you two numbers, so we estimate that the new tariffs put in place, and under our assumption that they're extended forward permanently, that raises $377 billion in revenue between 2019 and 2028, and the economic effects of those are to lower the level of GDP by 0.1% on average over the decade. I couldn't tell you. I think you may have said percentage point. So it's a very small effect on growth, but it's an effect on the level of 0.1%.
And that's a 25% tariffs if this go into effect. That's
No, I'm sorry. That's keeping the current level of tariffs and extending them permanently.
And sorry, where's the alternate scenarios?
That's going to be in Chapter 5. So on page 108.
And of course, if you think about it, you have sort of the inverse. I mean, this is an increase in taxes, right? So you have tax revenue, but you also have a drag on growth. So you have a minus from that. Now, obviously, one of the bigger risks, right, is with a tariff is what happens to confidence, right? If the 25% tariffs go in place, if the U.S. shows signs of not having a commitment to the multilateral trading system, that sort of thing, somewhere down the road that could have much bigger impact on confidence and business investment and et cetera. But that's just a risk out there that we really haven't taken into account. Yes.
But to go back to the tax cut and the deficit, is it accurate to say that the tax cut adds $400 billion to economic growth over 10 years at a cost of adding $1.9 trillion to the deficit? Is that fair? And where I come from there is that you said the tax cut with macroeconomic factored in costs $1.9 trillion. Without macro factored in, it would cost $2.3 trillion. So does that mean the tax cut adds $400 billion to GDP?
Yeah, that's roughly.
It reduces the deficit by $400 trillion because of the economic effects. So, I'm sorry, $400 billion. $400 billion. But because of the economic effects, so the actual economic effects we reported in April, the level.
What's about 0.7, for 10 years, GDP would be 0.7 lower than it would be otherwise over the 10-year period. So actually the GDP effects are much larger. But your interpretation's right for the deficit effects. But the GDP effects are actually a bit larger than that.
So over 10 years, does the tax cut reduce GDP compared
Excuse
with
me,
what
I
it
said
would have
down.
been?
It raises GDP, the level of GDP by 0.7%.
Okay. And is there a dollar figure that can be derived from that 0.7%?
Yeah, it could be calculated. I don't know it offhand.
It's going to be something close to 4 times $400 billion because that's roughly how you increase revenues when you increase GDP. It's roughly 25%. We haven't done that calculation, but that would get you in the ballpark.
4 times $400 billion.
Yes.
Well, so in table B2 from last
April.
year's, from April, we have the effects on the levels of GDP spelled out. You could you're probably better off taking our baseline from last April 2018 of GDP and just multiplying those through and accumulating the effect up. Well, that would be in that case from last year, $2009. So if you wanted to get an idea of dollar-wise, that's the way you would do it. But again, that would be comparing apples to oranges in broad sense.
I'd be surprised if you got something very different from $1.5 trillion. Dollars on GDP, given that we're estimating that that effect on GDP reduces the deficit by $400 billion. But we haven't done that calculation.
Yes.
On the federal government purchases, you have a big decline, and I understand that's because of the caps come back in, basically, right?
Right.
Have you done any cap calculations on what would happen if the level of spending was just, and the caps were not reinstated and you know.
Yeah, actually on Chapter 5, our alternate fiscal scenario, we have a few of those, what if, current law were changed. And actually I've got, no, I just don't have, on the visual summary there is a picture of the debt accumulation under current law, then there's the debt accumulation under an alternate scenario, and the alternate scenario has two changes. One is that the caps aren't in place, and the other is that the reduction in individual income taxes doesn't happen. And those would drive the debt up. Instead of 93% of GDP, it would be something over 100% of GDP after 10 years. Is that right?
Well, and increasing discretionary appropriations at the rate of inflation, so rather than going back down to the caps, increasing discretionary spending at the rate of inflation starting in 2020 would add about $2 trillion cumulatively to our projected deficits.
And what would the impact be on growth of that?
On GDP growth?
Yeah.
We haven't done that calculation.
Presumably higher, right?
Figure 5.1 on page 106 gives you the alternative scenarios for discretionary spending.
But you're right, it would be higher.
It would be higher in the short term. It would be higher in the short term because you'd get the stimulus from increases in federal spending. That's right. It would be lower in the long term as we would estimate that those higher deficits would crowd out private investment.
And the caps and the raising of the individual income tax, that's part of why we see the GDP go below potential for a while, is the effect of that. Yeah.
So are you not making any recommendations about what Congress should do based on your alternative fiscal scenario? You don't make any projections about what they will do, right?
Right, that's right.
That's not the CBO's role, so.
That's correct.
I'm sorry.
Yes.
I wonder if you could talk a little bit more about the long-run risk, because there's been a big pushback in this town against that deficits effectively don't matter. You have this monetary market theory, I think it's called.
Modern monetary theory.
Modern monetary theory. Jason Furman and Larry Summers have a piece out today suggesting, in foreign policy, suggesting that we're too fixated on deficits. I wonder if you could lay out maybe the other camp about why we should be caring about this.
Sure. Well, I mean, certainly we pay attention to that theory, but we really try to base our forecasting on actual experience. What's happened in the past, and we really do think that interest rates are going to go up to something like their normal range. We do forecast interest rates to be in the lower end of the range a little bit because of the aging population, but we really don't imagine that interest rates are going to stay low like this for a long time. So that's just one fundamental difference. So if you have interest rates rising back up like we think they're going to, then the debt's going to get worse. And a lot of it is the trajectory as well, right? It's not just that it gets up to 150%, but it's and rising.
Thank
you. Is there a single takeaway from this report, a single big difference, striking difference, compared to your report last year?
Well, I think the story is very much the same. One of the things that I'd like to emphasize that actually we haven't emphasized this time is if I go back to this graph here with deficits. One of the things we haven't talked much about now, but we did last time, but I want to emphasize, is this is under a time period of a very low unemployment rate. The economy's going well, and we're looking at deficits that are 4% of GDP going forward. All right, that's a very unusual thing. And if you look at something like, look at this graph, what does that mean? You notice that deficits go up and down. Well, we had a recession in 1980. You saw the deficits grow. A recession in 1990, deficits grew. Recession in 2001, deficits grew. 2008, they grew. Right now, we have no deficit and we have no recession, and the deficits are very high. If we go through a business cycle and we're starting at this level, then the business cycle would lead to very large deficits, much larger than we're seeing now. That's a concern in terms of a risk going forward. That's one of the punchlines I think that's really important. Yes?
One of the things that like MMT and Furman and some of the other economists have started arguing is more that, you know, economic growth is pretty slow and tepid, and you know, interest rates may rise in the future, but they've stayed relatively stable. So why should we chart our fiscal economic policy based on deficit projections that are 30 years away? I'd sort of like you to wrestle a little more directly with that argument that you brought up earlier.
Sure. Well, one of the things that you can do, and one of the things that we've got in our report, is we've got some what ifs. What if interest rates were lower than we project? What if they were higher than we project? If you look at something like what the effect of lower interest rates, consistently lower than we're projecting, what kind of effect that would have, you still have really significant deficits in debt going forward. It makes a difference. It improves things, but it doesn't improve them all that much. So that's one of the points I'd like to make is it certainly is true that interest rates are hard to project, and they make a big difference, but they don't just sort of fix things. You still have a high deficit, high debts going forward, even with low rates.
Two things that Keith touched on that I think are worth emphasizing. One is that even if interest rates stay where they are over the next 10 years, we'll have significant interest costs. And a lot of those interest payments get sent to foreign holders of U.S. debt. Those are resources that are, I mean, in technical terms, that's a difference between gross national product and gross domestic product. Those are resources that are leaving the United States and going overseas. That matters, and it's a factor. And it's something that we should think about in terms of how much of our economy is going to pay interest on the debt. But then the other thing that's of course completely unknowable is when investors might lose confidence in holding U.S. Treasuries, might worry about inflation risk or other risks of holding U.S. Treasuries. And as deficits remain high and as no plan is in place to make the outlook, the budget outlook more sustainable, those risks increase.
Dr. Hogan, your point about the high level of the deficit right now, is there a point at which there's no stimulus from a tax cut or no stimulus from a spending increase? It sounds like you're worried about whether or not the government will be able to react to the next depression or recession. So I'm wondering, is that what you're getting at?
Well, it is. It's not that we're projecting a recession or anything like that, but economies do go through cycles. And we do know that if we go through a cycle and have a decline in growth, and we go into a recession, that it's going to have a pretty big impact on growing deficits, and then therefore debt. Now, I'll give you, for example, the Great Recession was an extreme, but we had debt that was about 35% of GDP. Historically big, but not terrible. Great Recession doubled it, pushed it to 75% of GDP. Just from the Great Recession itself. So if you start from 78%, you're going to a really high level if we do have another cycle.
At that point, will the tax cut still work to be stimulus? Not a standard effect.
Well, we think the stimulus effect is only going to last for another year or two, right? And we do think it leaves us with a higher level of GDP. But the actual stimulus is whether it raises growth as opposed to the level of GDP is a different thing. No more questions? Excellent.
Thank you. Thank you very much.
Sure. Thanks. Thank you.
I did.
If you miss any of this discussion, you can see it in its entirety on our website, cspan.org. Go to cspan.org.